Folks, our guest tonight is Alex Muresianu. Did I get that right?
Yeah, no, that's pretty rare, but
Right
good
on.
on you.
A contributor to Young Voices, his work has been published in the National Review Online, the Orange County Register, and numerous other print and online publications, and he focuses on tax and regulatory policy. So I figured it would be great to talk with you because, first of all, you appear to be a guy with great hair, and we really appreciate that here on the channel. That's always a big thing. And beyond that, because, I don't know, tax policy is so, I don't know, it seems to be the thing that undergirds everything else we do and think about in this country, and yet one of those issues that we just don't talk about enough. Maybe because it's complex, because it's hard. I don't know. Do you think that's a fair assessment of tax policy? Kind of the unseen hand that gets at every decision that we make in this country?
Yeah, I think there's a lot of truth to that. I mean, when you think about the number of issues that tax policy touches, I mean, in some way or another, it touches everything. From, if you want to think about housing, the importance of the mortgage interest deduction in determining how Americans think about home ownership. If you want to talk about different treatments of different types of capital investment and how that determines strength of manufacturing, or whether or not we have a carbon tax and fossil fuels, or there's a great piece from Josh Barrow in Business Insider, I believe, back about, maybe it was New York Magazine, about white claws. That we have white claws is that they're taxed like beer, but they're essentially a vodka soda, but you can't buy a vodka soda because vodka's a spirit, it's taxed differently, but yeah. White claws are taxed like beer, so it's cheaper to get a vodka soda in the form of a white claw than something else.
Damn. So they are taxing people. So basically, what is that? That's like a tax giveaway for hard liquor in the form of taxing it like beer.
Yeah. So most states have lower beer taxes per unit of alcohol than hard liquor, except for I believe Kentucky. I think it was Kentucky or Tennessee.
Because Kentucky and Tennessee are big on brewing their own hard liquor, right?
Yeah. So they have a much higher tax rate on beer than other states do.
Fair enough. Well, so let me start off and ask a question here. So I was doing some reading into some of what you've written in the past, and I saw an article that you wrote last year where you said that tax policy did not cause income inequality. And the reason I'm curious about this is that we've seen income inequality grow since the Reagan administration, where the top tax rate went from 70% to, I think, 28%. And inequalities only continued to climb since that period in American history. How can you say that tax policy, which was maybe one of the hallmarks of Reaganomics, had no effect on that? Didn't start that off, especially with a drop in top marginal tax rates that high.
Yeah, I mean, I think that there is an important sort of issue here of basic policy analysis, where just because a policy is sort of enacted at a specific time doesn't necessarily mean that the thing that happened after it is a result of it. So basically, what happened to drive long-term income inequality? I mean, it is multifaceted. I think it's a mistake, of course, to say that general rule, nothing is really monocausal. But I mean, one of the explanations is that the sort of increase in globalization during the 1980s basically had the effect of, in the United States, of enhancing the productivity of sort of high-income professionals much more than it did, say, blue-collar workers. And that is a trend largely independent of tax rates. But sort of to point that might sound like an anti-globalization spin.
A little bit.
But the reality is that the benefits of globalization mostly when it's what people call the elephant graph, where sort of the benefits of globalization for people around the world sort of go up, and the people who have benefited the most from globalization are the global middle class. People in sort of more developing countries have gotten better off sort of much faster. And then the sort of people who have benefited the least are the sort of middle or lower middle class in the United States, which is unfortunate, and we should have policies to address that. But I think that the important point is that, like, broadly around the world, globalization has been a huge victory for humanity as a whole, even if it has problems in the United States.
So you're saying the tax cuts had nothing to do with it?
I mean, I wouldn't say that it's not a. I mean, again, it's not a monocausal story. I mean, I know a lot of people also talk about the structure of labor markets. The labor markets have become more monopsonic, is the word economists use, where individual employers have a lot more market power because corporate consolidation means that there are fewer employers, so they compete less for workers. And I think those sorts of things are these sort of broad trends. And I mean, I think it would be a mistake to say that, that if tax rates weren't a little bit higher, then you would have seen a little bit less income inequality increasing. But the idea that this is a sort of core cause, I think, is a mistake. Also, it's important to note that in a lot of the two tax reforms passed in the 80s, they also included a good chunk of base broadening and eliminating tax loopholes and stuff. I mean, if the code is bad now, it was even worse in that regard.
Yeah.
Before the 80s tax reforms in most cases. So I think that's also worth noting in the context of seeing the big sort of decline in the marginal rate.
So so I guess is part of that growth among the global middle class and their success through globalization, would you include maybe the growth of the financial sector in that? I mean, it seems like our economy has gone farther down the road of the financial sector taking a bigger piece of the overall kind of overall economic activity, right? It's been a real growth industry is finances, right?
Yeah, that's actually something I have been thinking about and haven't really developed a take on, is this sort of idea from, I think, a lot of national conservative types, and I guess some people on the left as well. I mean, I think it actually probably originated with people on the left.
Sure.
That, the over-financialization of the American economy is a problem, and I haven't really developed my take one way or the other.
Well,
sorry, go ahead. But I would say that there are some interesting things as far as how tax policy perhaps disadvantages like manufacturing, because under current law, what you have is, ideally a corporate income tax means it applies to corporate profits, which is to say revenues minus costs. But for sort of big capital investment projects, think a steel mill is a perfect example. It's a bit old of an example of the sort of old school econ textbook. This is how things work. But a steel mill, big project with a lot of heavy machinery. Ideally, a steel company, you take the cost of the investment that you make and you subtract it from your revenues and you subtract your salaries of your workers, and then you get your profits and you pay your taxes on your profits. But what the current system has for different assets, certain assets, instead of deducting them immediately, what you have is you have to spread them out over many years. And the result of this is basically because of inflation and the time value of money. Dollar today is worth more than a dollar tomorrow. You don't get to deduct the full cost of certain types of investment, like predominantly ones that are heavily used in manufacturing, like big structures or machinery. And so what you see then is that advantages labor-intensive companies, because salaries can always be deducted immediately as a cost. That can be anything from a sort of financial services firm or like a retail. Those you can deduct immediately, but your big manufacturing company, they have to spread the costs out. So that creates a bias. So I would be interested to see if that might not be a cause of financialization, but I think that is an underrated policy to, if the concern is over financialization. I think that shift would actually probably help reverse that, or at least invigorate manufacturing.
Well, if you would agree with that notion that there might be, or if you would at least be open to the notion that there might be over financialization of the economy, then why would you oppose, as I saw you did in another article with the Tax Foundation, a financial transactions tax, which would seem to to get at that.
I think the issue with the financial transactions tax, which is another sort of core, another is a good example of another core principle of tax policy, is you don't want to tax the same money twice, and that's largely what you end up doing with a financial transactions tax. Additionally, it's also important to understand that capital gains the types of transactions that financial transactions taxes cover are quite mobile across borders, which is to say, a good example is, Sweden imposed a financial transactions tax. And when they did, 60% of the Swedish stock market left.
Where'd they go?
I can't remember where, but whatever it wasn't Sweden.
It wasn't Sweden.
Yeah, and so what you see there is, there's sort of two different approaches to talking about taxes like that. There's there's mobility across borders, and then there's like economic sort of supply of labor and capital. So, and a good example would be like when states try to do millionaires taxes or something like that. A concern is not necessarily its impact on millionaires like working more or working less. It's not a labor supply thing. It's about it's a little bit more about where do people move out. And there's some evidence. I think there was a recent National Bureau of Economic Research paper that found, I can't remember what the specific change that California did, but basically they found that enough people moved because of it that they lost half of the revenue they expected to gain just because people moved. Now the benefit of that, it also varies like between types of taxes, how mobile different things are across borders. This is why I don't like it when conservatives are like, why hasn't Vermont done single payer if they think it's so great? And it's like, well, it's a lot harder to move from the U.S. to Canada than it is to move from Vermont to New Hampshire.
Right. Yeah. So if you didn't want to pay for that system, or if you wanted to use that system, it would be a lot easier to come and go than it would be.
Yeah.
Well, okay. So then, sure, at a state level, it would be harder. But what about? If we take some of these ideas and we were to implement them nationally, leaving the United States, is a much bigger prospect than, say, leaving one state for another. Even I know the financial transaction tax you explained. Leaving America's stock exchange would be a whole other magnitude of difficulty, would it not?
Sure, but I think it's also important to understand. That it does sort of mobility of capital and labor varies, and I think broadly labor is less mobile than capital is. So you would see a lot less of that from, say, raising the top marginal rate. I think would probably have less of an impact on shifting of economic activity or location of transactions or whatnot. The relevant things that you're trying to tax would be less slippery if you did raise the personal income tax rate than tried to do financial transactions or something like that.
Let me ask you, you mentioned double taxation and money being taxed twice. How do you, can you give me an example of that? Because that concept seems to be sort of, nebulous in a way. Like, for example, when my employer receives money, right, that money is, that money has been taxed, right? And then they pay me out of that money. And then I, am in turn taxed off of that. So, money can be taxed multiple times, I guess. I understand that this is presumably the money that I get being taxed multiple times rather than that. But I guess how do you, can you define double taxation here?
Yeah, I think it is a somewhat sort of nebulous concept. It depends on how you define what is and is not like fair, or what is the correct tax base, I guess.
Yeah.
I would say that, I guess a good example there would be, if it's your employer, if the employer can't deduct if your employer paid taxes on revenue instead of profits, and did not deduct your salary. Sorry, I don't know what that is. Somebody's dragging cans. I don't know if you can hear it.
No, it's all right.
If your employer couldn't deduct your salary, but you paid taxes on your income and your employer paid taxes on revenue.
Yeah.
I think that would be a good example of
Okay.
double taxation. I'm trying to think of other good ones. Usually like retail sales taxes are typically supposed to be imposed on sort of final consumption decisions, or like final consumption. And so if you put a sales tax on a business input of some kind, then that could also be a form of double taxation, because you're taxing the final consumption and also something else along the way. Yeah.
So isn't that though the way I guess a VAT tax works? Like I remember reading that you were saying that a VAT tax would be an improvement over a payroll tax, for example, right? But isn't a VAT tax kind of a cascading tax that where each time an input is added? Like maybe you could walk me through that. But I thought
Sure.
one that is a tax that works in a fashion that seems like it repeatedly adds a layer of tax to a product as it goes through the system, and then two, that it's ultimately kind of regressive, isn't it? It's something that falls upon the consuming poor more than the rich.
Yeah, I mean, the VAT is tricky, and it took me a while to understand this as well. And
Okay.
it's useful to compare it to something called the gross receipts tax,
Okay.
which seems similar but is actually different.
Yeah, I've worked with some gross receipts taxes before, but I've never worked with a VAT tax, because I guess we don't have them in this country, right?
Yeah. So I guess the idea of a VAT is that at each stage of production, you're taxing like the value added at each stage of production. So
Okay.
like if a mining company, I like have some natural resources that I sell for $40, and I pay the VAT rate on like $40, and then some processing plant takes them, and then they pay taxes, and then their sort of processed good is worth $60. They pay taxes on like $20 tax they would pay, because they would only pay taxes on the $20 because that is the value added at that stage of production. Gross receipts tax, company A would pay taxes on $40, and then company B would pay taxes on $60 rather than 20, even though 20 is the value they added in that stage of the production process. And so you run into big problems with gross receipts taxes, because sometimes when you have very sort of long supply chains with a lot of different intermediate producers, you end up with like several times the gross receipts tax rate might be like 2%, but effectively you're going to tax it at 30, because you have so many different layers.
Oh, I see. So that is like way more unfair than the VAT tax. It seems like the way you just described it.
Fair, or I'm lost. How?
Or, well, I mean, it seems like maybe I'm missing something here, but like you're saying that rather than taxing the value added, you're taxing the whole thing.
Yes, but the trouble is that you're doing that at every stage of the production process, which sort of creates an issue where you have a company. So if you have a company that there is like one in between, if you're just a brewer, let's say, and you just sell directly to customers, you only have to pay taxes on that once because you do everything in-house.
Yeah.
But if you're another brewer and you have a supplier who grows wheat or barley or whatever, and then a different you sell to a restaurant that provides the beer, then you pay taxes several different times. Like that's taxed both at the beginning of the process where they sell from the farm to the brewer, and then to the restaurant, and then to the consumer. Like these are all taxed as if they're final, and those things sort of stack up, and so you end up taxing that group of transactions much more than you do the company that just does everything in house.
Okay, I see. And that's again with the value added tax, right?
No, that's the
gross receipts tax. And so then how would that be different than with the value added tax?
So the value added tax, what you would do is, I mean, the total value added for both of these examples is going to be the same. So the value added tax would mean you would pay, if you have, a total of $100 of value add
Mm-hmm.
over the course of the time, then like you pay the same amount for
Mm-hmm.
both. Let me see if I'm explaining this right.
Sure.
Yeah. Okay. So with gross receipts, what you would do is that you would be it would end up stacking much higher. It would stack in a way that like it's the same.
Oh, okay. I think I get it here. Somebody I think just wrote it out in the chat in a way I think I get. I'm sorry for the delay here, but it seems like basically if each step adds $100, then you're paying 20% on that each time, right? With that each ad. With the gross receipts, you're paying 20% on the whole thing. The whole final $100, like the final amount, right? So
that might be a sales tax.
Okay.
If you're playing on the final, if it's just on the final, I mean that's a retail sales,
Yeah.
Which is a tax on the final consumption. But the trouble is, I mean I guess that is a good explanation. That is a useful explanation. It's like if you had a 5% retail sales tax at every stage of the production process, where it is applied to the final, or like the transaction. I sell something for $60 and I pay 5%. So that's $12 of taxes. And then, I sold another thing for the next guy, the distributor, sell it to him for 80, and then another 5% on that. And then you end up paying, much more than you would if it was, just the value added. So it would be 5% of 60 and then, or 5% of 20 and then 5% of another 20.
Something I'm curious about with this is, given the nature, like the distinction between the two taxes, is there some impact on this in with respect to vertical integration? Like, would there be some advantage under one system to doing everything in house, maybe, versus another, which might advantage specializing in some part of the process or another?
Yeah, I mean that's the core of the issue, that the gross receipts essentially incentivizes you to have as few stages of the process as possible, because again, value-added tax is neutral because it's just about the total value added. If you have one step of the process that adds $60, or 3 separate processes that each add 20, you're going to be taxed the same. If you have gross receipts, you pay taxes on the sort of final value each process rather than just the value added on each process, so you end up paying more. So basically that's what gross receipts basically bias against, having multiple companies interacting. And
wow. So that does seem like our gross receipts taxes in the U.S. would like incentivize concentration of business rather than efficient operation of business.
Yeah, I mean, gross receipts isn't my beat, as you might have picked up.
Sure. Well, I appreciate you walking through how to teach gross receipts tax and value-added tax to a Twitch streamer. I appreciate that. But nevertheless, I mean, I think what was really interesting about that is I had never thought about that concentration of industry issue, because that's such a problem in the United States. It seems like is at least a growing problem. Concentration of industry and how government might push that along. Even unintentionally through the tax system. So
I mean, I don't know how big the gross receipts taxes were, because they're only in a couple states. They're not super widespread.
Okay.
But that would be sort of a again, as I talked about at the beginning, things are not monocausal. That probably maybe on the margin has some impact. But actually, I have not actually looked into that. Like, that's something I always known as a concept, that like gross receipts taxes, they'll make it worse for companies that are not integrated, or like fully, have an integrated production process. But I haven't done the digging on that.
Yeah, I'm not sure how prevalent they are. I live in Florida where I practice, and so I deal with gross receipts taxes sometimes. And I hadn't thought about whether they are nationally prevalent or just a thing in a few states, like you said. But it's interesting to think about. So why don't we have any of these great value-added taxes in the United States? What's people's hang-up with them?
I mean, I think there's a famous quote. I can't remember who said it. I think it dates back to the 90s.
Yeah.
But basically, the point was that conservatives don't like value-added taxes because they think they are money machines to fund big government, and Democrats don't like value-added taxes because they are regressive consumption taxes on the poor. And if we could only get the Democrats to understand that they are money machines for big government, and Republicans understand that they are regressive tax on the poor, then we could get value-added taxes.
Oh, that's a good one.
It is quite a pithy quote for whoever said it, which is quite unfortunate that I can't think of whoever it was.
Man, we're gonna check that out. Yeah, that's a good one. Maybe somebody in our wonderful chat can figure that out because, man, that's interesting.
Yeah. I mean, I think it is also. I mean, I think the article you're thinking of is I proposed replacing the payroll tax with the VAT, which is, like, on the whole, not a huge improvement. Like, economically, the payroll tax and the VAT end up working kind of similarly. They're both basically mostly fall on labor. The only benefit of a VAT relative to the payroll tax is that VATs basically tax, like, if you're I mean, I think this might be the article you're thinking of, where basically, if you're a rich person who has, like, a big inheritance, you don't pay payroll taxes, but, like, if you consume a lot, you end up paying a VAT. And I think that is a sort of illustration of somewhere where VATs might be a little bit more advantageous than payroll tax. But I think, I think it is also, again, like, Republicans don't like creating new taxes, period. And I guess Democrats, because it's regressive, it's not really something that they'd rather talk about something that doesn't raise that much revenue, but it has that sort of progressive, it would literally, like, things that literally make the tax code more progressive, but that don't raise actually that much revenue.
That's interesting because don't they support something that I think, I'm not sure if you could call it regressive or not, but aren't Democrats in favor of the state and local tax exemption that was scaled back a little bit at least somewhat, by the Tax Cuts and Jobs Act, the Trump tax cuts? Don't they support that, even though it seems to be a big giveaway for the rich?
Yeah, I mean, I think it depends on the Democrat. I actually think, to her credit, I'm not, her biggest fan, but Alexandria Ocasio-Cortez is not a fan of the SALT deduction.
Oh, that's true.
And but other Democrats are, and it is quite. I think the stat was from Richard Reeves, who's an economist at Brookings. It's something that, like, the average, if you reinstated the SALT deduction fully, it's capped now that you can only deduct, I believe, 10,000 in state and local taxes if you itemize. I think the Richard Reeves said something along the lines of, if you got rid of the cap, this would help, the average middle class, on average, help a middle class family with about $25 on average, but, help, somebody with $1 million in New York, couple, I don't know, was it 100,000 or can't remember what the number, but
a lot more than $25.
To that, I'm just saying a very large number off the top of my head, but there is, like, the vast majority of the benefits of uncapping the SALT deduction would go to the top 1%.
Damn. Yeah. Well, let me ask you this. So, why do we? This is something I'm curious about. Why do we tax corporations in this country at all? Don't corporations, when they get a tax bill, generally just pass that on to their customers? I mean, if they possibly can. Isn't a tax on a corporation fundamentally just a tax on the customers of the corporation who buy the end product?
I mean, I think the tax on corporations falls on a lot of different people, a lot of different ways. Some of corporate tax is passed on to workers by the form of lower capital investment. So basically, I know that you might have a good chunk of people in the chat who aren't a huge fan of classical labor market models. But, like, broadly, the idea that at least productivity and wages at least flow together, whether or not, like, they flow perfectly together, but, like, an increase in productivity will lead into some increase in wages. It's not,
did you just very classily call my chatters a bunch of commies? Was that what that is?
putting words in my mouth. I never said that. I also can't see the chat.
I'm just teasing you. I'm just teasing you.
Uh, um, but yeah, and so if you have lower investment in capital, then workers do not become as productive, and so wages rise slower. And then some of it is paid by shareholders or the owners of the company. And how that works kind of depends on how the corporate tax is structured. Again, with what I was talking about at the beginning about how investment is deducted. I think if you had a proper sort of cash flow based tax where you had all investment be sort of fully deductible immediately, then I think the economic cost of a corporate income tax would be a lot lower if companies could fully deduct the investment, which is where the sort of cost of the corporate income tax comes from.
So it doesn't sound like then really. It sounds like that whole idea that corporate taxes fall on customers is mostly nonsense.
I mean, I'm not actually super. I don't want to put it. That's not usually what I think of when I think of corporate taxes. I mean, I think some of it is probably passed on to consumers in various ways. I mean, I guess lower quality goods, like if you have lower investment, then you have lower quality goods, you're paying more for less, which would pass on to consumers. But I think that's not usually what I think of when I think of corporate income tax incidents.
Okay. Well, let's see. What about what about this argument that I hear sometimes? So we've got these taxes on capital gains that are taxes on basically investments, and we got these income taxes that are taxes on work. If we want to incentivize work and we want to incentivize investment, wouldn't the best way to do that just be to scrap both of those and then tax something else? If we could get this value-added tax, for example. I mean, wouldn't that be the way to go? Don't these fundamentally, make us less efficient workers, less efficient investors?
Yeah, I mean, I think it's also important to note. I mean, I think there are some aspects of the income tax partially falls on consumption, and the value-added tax, entirely falls on consumption, basically. So, and then I mean, I also think that like capital gains is not particularly. I mean, I think this gets to one issue that is related to usually in other tax contexts about deficits, but that like the idea that capital gains, the idea that there's a problem because there are not enough like savers, and that if there weren't enough savers, then you would see interest rates go up, which means people wouldn't invest. But I think the issue here is that like with markets being largely globalized, hook back to the beginning, there's if there aren't as many savers in the United States, then other countries, savers from other countries will come here to lend money. And so basically in a sort of global or sort of open economy model, the impact of changes in like domestic savings isn't that big as far as overall investment in the United States. So the sort of economic benefits of capital gains cuts now are probably lower, than they might have been 20, 30, 40 years ago. I think that's also something to note about deficits, where like back in the day, I think it was more genuine for people to talk about the deficit because you could see a much greater impact on interest rates back then from the deficit, because I think markets were less open around the world. But now, where you've got all this demand for loanable funds, to use the intermediate macro model that some people might still be familiar with if they took it in macro. There's more demand for loanable funds to go around. So like an increase in deficit, wouldn't have as big an impact. Sorry, that was a weird answer for you.
No. That is actually really interesting, because once again, that makes me think about something else here, like with the whole vertical integration issue that I didn't plan to talk about at all. That just kind of came up as we were thinking about this. It sounds like you're giving an answer that I've never really heard before with respect to deficits. typically the question is, do deficits matter? And the answer is either yes or no. And it sounds like what you're saying is, well, they used to matter more than they do now.
Yeah, that's basically my thought process. That, and I mean, it's not to say that like,
and presumably the federal deficit here.
Yeah, federal deficit. States are weird, but the way that like people talk about, I think that there's unfortunate binary thinking of deficits are bad or we don't need to worry about the deficit, and that's sort of a bad way to think about things, where right now, like, concerns about the deficit right now are less relevant than they were a year ago, because we're in the middle of a recession, and the cost of not increasing aggregate demand or increasing your social spending is a lot higher than it was a year ago. And so like, or like the marginal impact of, say, I mean, this is the point I always try to make when I'm talking to somebody who's, wants to have sort of more government programs, is the marginal impact of borrowing $10 billion to fund pre-K programs. It's like, I don't really care how you're going to pay for that. Like, you could borrow money for that, and that would probably be fine. But like, if you wanted to borrow $32 trillion, like, you're probably going to run into some problems there. Like, that's going to start to show up as far as the market for loanable, like demand for loanable funds. That's a pretty big jump.
Well, now this is the, as in $32 trillion, another large number, because at that point, then you are soaking up money that might otherwise be invested into private business, right?
Yeah, I mean, I think that I mean, the thing is that I don't think there's ever been that big of a federal borrowing, ever. Unless there's something weird about World War II that
I mean, maybe there's something with World War II.
That's there off the top of my head. But even there, that's a very short-term thing. That's like 2 years you're going to kick Hitler's ass. We're going to, do something. Whereas Medicare for All is like a permanent program. So there is that. But yeah, so that sort of big jump is I believe unprecedented. Oh, I hate that word. I just use it. Oh, well.
Well, that was a word, I guess, that has taken on new meaning this year, right? A lot of unprecedented situations.
Yeah. that's the way it goes.
What about this is an issue we talk about sometimes. What about the notion of saying, okay, look, income taxes, capital gains taxes, we've got them, but why is it that capital gains income is taxed less than the income I make on my paycheck as a working stiff? Why don't we equalize those? Income is income is income. And I got to tell you, in all the reading I've done on this, I can't really find, it's not like a lot of issues where, rent control, there's a pretty good consensus against rent control. But this issue, it seems like there's a lot of division on this. So I was really curious what your take would be on the notion of, fair is fair, they should be taxed the same, versus no, there are good reasons to have a lower capital gains tax.
I think that this actually I'm kind of annoyed at myself that I didn't think of it. This is actually a much better example of explaining double taxation.
Sure.
So I mean, I think a sort of similar example is how 401ks work, where the idea is with a 401k, the purpose is to only tax the income once. So let's say, you're working at a job, you're an accountant or something, and you earn your salary and you put some of it in the stock market. You deduct it now, and then you pay taxes onto that plus your, gains or whatever in the future, as opposed to paying taxes on that income now and then investing it and then paying taxes on it plus your gains later. Basically the idea. So that would be a form of double taxation. So that's the theoretical justification for having some kind of different rate on returns to saving than on returns to work. I think that is the theoretical argument.
Okay.
In practice, I think that my understanding is basically for the reasons that I talked about before about saving, that it's not the end of the world to raise the capital gains rate. I don't think it has a huge economic impact. That's my understanding of the literature. Like there was some American Economic Review, I think, paper about like the Bush tax cuts had pretty convincing evidence that like there wasn't much of a response to the change in tax rates on dividends. And there's, I think, a pretty good literature on recent capital gain tax changes not having a huge impact.
So it sounds like
it might theoretically, in sort of an idealized tax system, if you're drawing it from scratch, you probably would have, universal savings accounts where, you don't have, you make sure that income is only taxed once and that you don't tax it when you make it and also when you cash in from saving. But I don't think that's a super high priority to me.
So the best argument against it is theoretically when you draw out the example, it's unfair comparatively because in the one scenario with the income tax, you're being taxed one time. And with the capital gains tax, you're being taxed twice, so the lower rate makes sense.
Yeah, that's the theoretical argument.
Right.
But
the theoretical argument, though, as opposed to the, I guess, more practical argument of, well, if you brought it up, it wouldn't change much because people aren't really, we have a low savings rate in this country.
Or like we don't have to worry about, we don't have a problem of a savings shortage in capital markets right now. But like it's like you have to pick your battles with tax policy, and I think that like, Republicans picking capital gains as their battle is stupid. But like,
well, so then what are some real low hanging fruit, right? What would be some real easy ways to improve our tax code in a meaningful way? Like, what's a real bad tax out there hanging out right now?
I think like my sort of first choice for a tax reform would be what I talked about earlier, which is to make sure that companies deduct their investments the first year that they're made. Because what you're doing there is that this is basically the best growth policy that you can come up with, because what you're doing relative to a corporate income tax is that a corporate income tax, when you lower the corporate tax rate, you're lowering taxes on the returns to investment, which means that, the payoff is larger, so you're more likely to invest more. There's pretty strong economic literature that says that, capital is more responsive to taxation than labor. So you get more investment. That's great for productivity, economic wages. Awesome. But the thing about the corporate income tax is that you're not only cutting taxes on the returns to new capital, you're also cutting taxes on the returns to old capital. If I have a factory that I built 10 years ago and I get, $1,000 a year, and suddenly you change the corporate tax rate, like, maybe I do something different there, but I'm getting lower taxes on things that I was, already doing. Whereas with allowing what's, called expensing, deducting capital investments the first year that they're made, you're effectively reducing taxes only on new investments.
I see.
So as far as the total revenue you lose from doing that, it's lower per dollar of growth that you create from just lowering the corporate rate. But the unfortunate sort of political reality is that, that benefits more new businesses that like are investing a lot now, which is not really the same businesses that are more politically connected or active or whatever.
I see. Like when we were talking about steel mills, for example, there are steel mills in places like Pennsylvania and Ohio that are very old and very politically connected that often demand tariffs, and then there's steel mills in places like Arkansas that are not so old and they're newer and more efficient and not so politically connected.
Yeah. Or, and there's, other examples. I mean, that is the thing about expensing to me, is that it's important for a whole variety of things that we need more of. Like if you want any more of stuff, like anything, like if you want, say, one example that it's something I've been working on recently is about, energy, that you want to accelerate the transition that we're currently seeing in the energy sector, in the power generation sector, to wind, solar, renewables, things that don't emit carbon emissions, or things that emit less carbon emissions, like switching from coal to natural gas. You would want sort of lower taxation on capital investment, because that sort of influences on the margin. Do I keep my shitty old coal plant,
Yeah.
or do I spend the money to replace it with a natural gas one or get wind or solar? And so on the margin, if you allow sort of full expensing, you're more likely to decide to switch rather than stick with the old stuff.
And you're saying that you could lower by making this change to where you could deduct it all in the first year, right? Instead of having to spread it out over time. That you could have lower taxes and you could generate growth that would make up the difference?
Oh, no. This does not pay for itself.
Okay.
Does not pay for itself.
Okay, because I wasn't. It sounded like you were saying something a little different from that, but I wasn't sure.
I guess the more accurate way would say it would pay for more of itself. Like it would pay. It would be, you might get you'd get more growth per dollar of revenue you're giving up, which is the same. If you would get, you'd get a greater return basically, and that might mean that you'd get, 30%. Maybe it would pay for 30% of itself.
Okay.
But not. I do not want to pretend that I'm selling the same, Laffer curve.
Yeah, that's what I was asking about.
Laffer works fine if your tax rates are 80%, but if they're 20, it's probably not super relevant for what to do.
Yeah, that's what I was curious about. Was that I know somebody made the argument. You can cut taxes and have growth that makes up for the loss in revenues from the tax cut, and then other people say no, that never works. And it seems like it did work at least at first with the first round of Reagan tax cuts because the rate was so high back then. But that subsequent tax cuts, that theory is not really panned out because rates were already lower. I don't know. Could you tell us a little bit more about that?
I actually am not sure that is true of the first Reagan tax either. It might be true actually of the Kennedy tax cuts.
Oh, okay.
When the rate I believe was 91.
Whoa, okay.
The top rate was 91, which was cut to 70.
Yeah.
And if I'm remembering correctly, there was revenue growth after that point. Okay. But again, I think that it only becomes relevant if you're talking about like really big tax increases.
Really big tax. Okay.
That only then do I say like you're probably actually going to lose revenue there. But like you want to talk about lowering the personal income tax rate like from 37 to 35, I'm like, yeah, you're going to lose revenue. Okay. But like raising it to 90, that's a different story. But
did the Tax Cuts and Jobs Act pay for itself in any way?
No, not really. Not on net. I mean, there were stuff that did like, it was, I can't remember what the exact number is, but it's, 4 trillion of tax cuts and 2 trillion of tax increases or whatever. I mean, unfortunately, it's really hard for something as sort of macro scale as like a federal tax change to disaggregate what economic impact is that versus just mainline, just what is happening before or other policy changes. So it's hard to say exactly how much revenue feedback was generated, if it was 10% or 5% or 20%. But what you do see is that like the idea that a tax reform that is like 90 is, on a static basis, just without factoring in economic impact, that was like, 100 billion of tax cuts and like 95 of tax increases, that maybe you increase taxes in ways that are less distortive and cut taxes that are more distortive, and that on net, your $5 billion tax cut on net would pay for itself subsequently. But like, if you're on net cutting taxes by that much, like relative to your revenue raisers, it's probably not going to happen.
Okay, that makes sense. So you can imagine a scenario where you could still come out ahead based on how distortionary the tax in question is. But barring that, generally speaking, unless you're working with real high rates, you're not going to get more out of the tax cut in terms of government revenue than you lose through the cut.
Yeah,
okay.
Yeah.
All right. Let me ask you about another kind of tax I'm curious about. So a lot of times when we talk about climate change and dealing with the environment, folks will come out and say, well, what about a carbon tax? Why don't we just tax the externalities that come with fuel and fossil fuels? And I know Canada tried this, at least, I don't know if they've still got this, but I know that folks have tried carbon taxation to at least some degree.
Yeah.
Do you think that carbon taxes, maybe, not asking, I guess, for your take on whether they could work or environmentally, although, if you could speak to that, that would be, great too. But I'm curious, would you view that as a really a distortionary tax, probably not worth a cost, or is that something that could be part of a, could that be a well-structured tax, or would it be just a mess anyway you slice it?
Yeah, I tend to be pretty friendly to carbon taxes.
Mm-hmm.
I think that, I mean, I guess the thing about taxes or Pigovian taxes or taxes on externalities is that
Mm-hmm.
like the problem is that there is not a distortion in the market, or the distortion is that there's some cost
Yeah.
that isn't properly priced in, and so you actually kind of want to have this kind of distortion put in the market.
Mm-hmm.
I mean, I do think that if you input a carbon tax, and it depends what you do with the revenue. I mean, that is another thing about tax policy that is tricky to understand, is that like most taxes in a vacuum, like they basically all hurt the economy, whether you're using a supply side or demand side understanding. Either you're taxing labor or capital more, which means you supply less, or you're just taking money out of the economy, so you're reducing aggregate demand. But like, if you did something and then spent it all on the invention of, hyper fast internet something or other that uses productivity through the roof through some DARPA program.
Yeah.
Like, then you probably might come out ahead because the created by that spending, this sort of research, outweighs the cost of the revenue. And so like the impact of the carbon tax partially depends on what you end up doing with the revenue. You could give it back to people just to ameliorate the economic sort of regressive nature of the carbon tax, or you could use it to cut more distortive taxes, or you could fund green energy. You do all of these things. So like there are economic costs associated with a carbon tax, but I think for the environment, I mean, the advantage of it relative to all kinds of other programs, I think to me is fundamentally about like public choice or like political economy, where the advantage of it is that it is the same across technology.
Yeah.
That if your technology is like reduces, it's simple. It's simple. It's the same. It's not subsidy programs that are distinct for each separate technology that maybe probably don't end up reflecting the relative merits, just because it's not as exact, or there's a lot more opportunity for fuckery is what I'm trying to say with separate subsidy programs than there is just like one flat carbon price.
Yeah.
Well,
I mean, that does make sense, because I guess that's what we're dealing with right now, right? Where occasionally you'll get a subsidy, I suppose, that makes some sense, and occasionally, perhaps more often, you'll get a program that certainly does not. And I know I work with utilities, and utilities get all kinds of special handouts, attempts to subsidize one behavior or another that often very routinely backfire, and sometimes occasionally achieve the exact opposite of what was intended. So, okay, let me ask you this more broadly. How do you feel about I guess the sort of rising approach among folks on the left of just saying, look, we need to increase taxes on the rich for the sake of driving down inequality, and we need more taxes to pay for, we need to tax them specifically for that purpose. First of all, I mean, that's something you could ultimately do if you were so inclined, right?
Yeah, I mean, I think that the important thing is to there are plenty of ways to increase taxes predominantly on high income people in the United States, or even companies in the United States that are less distortionary. And what I always try to do is push people towards if you want to do this, do this. A good example would be keeping the SALT cap, or just getting rid of the SALT deduction to begin with. It mostly benefits people at the top 10%, if not top 1%. Same goes for the mortgage interest deduction, which not only is mostly goes to wealthy people and doesn't have a huge impact on growth, it also creates a lot of distortions and incentives in the housing market that like means people use housing as an investment rather than consumption, which means that they want to put zoning regulations in to keep their house value up. These things are all connected. They're all connected. So like that would be one way to do it. I want to say CBO modeled getting rid of itemized deductions, and I think it was somewhere around $1 trillion or 938. That number sticks in my head. Something like that over a decade. You could do. I'm trying to think of a couple other examples. Stuff like that is like I think where you'd start if you wanted to fund a big government program. But like. The basic idea is to get rid of these deductions. Loopholes, I don't love using the term loopholes, and there are examples of things that I think are appropriately called loopholes, but like deductions are actually put there for a reason. It's not like a writing error. It's like some people actually deliberately sat down and were like, we would like to do this. It's not some sort of bad legal writing itself that is the problem. It's like policymakers making conscious bad choices. Sometimes there are loopholes, but
but generally, I get what you're saying, and I appreciate that you make that point because it does seem a lot of times when people think about not just taxation but law generally, like there's these secret tricks and loopholes and magic words, and as opposed to policy that like you just said, you may think it's good or bad, but it's typically intentional. So, okay. Let's see. Some other taxes. What about just some questions from our wonderful chat here? What about, do you think maybe this is another example of what you talked about with carbon taxes and taxes on externalities? Things like taxation of gambling winnings or taxation on specific goods like, I guess, sin taxes on sugar or alcohol or whatever. I mean, do you feel like those are effective or more harm than good?
I think those can be really tricky because I understand the justification for them, but I think it really varies across types of sin taxes. Like I can't remember what the specifics are. It's either alcohol taxes aren't high enough to pay for the economic cost of alcohol consumption, or cigarette taxes are not high enough to pay for cigarette tax. One or the other was the argument that I heard. And there's also a problem of implementation. Where like I think if like cigarette taxes, a big problem is like in a lot of states is illegal cigarette, loosies, and even if you were to set the tax rate to actually correctly price in the costs of lung cancer and secondhand smoke and whatnot, it might not matter because the result won't be people buying less cigarettes. It'll be people buying cigarettes from the guy in the corner instead of from the dollar store or whatever, from the convenience store. So you're not really doing that. I think that is an issue not of their sort of impact on activity and there's impact on like compliance. I think the problem is that like with cigarette taxes in particular, it's not necessarily a problem of like it does not make sense to tax cigarettes that much. It might, I can't remember the specifics of like what the idealized sort of pricing and economic cost is. I can't remember the specifics of that, but like, even if you might set it to that price, and that might not be ideal just because people end up evading the tax. So it might make sense to set the tax lower that reduces cigarette consumption the most without leading to people just going to an illegal market.
So you got to find the sweet spot so people don't start smuggling.
Yeah,
basically.
Yeah,
right?
I mean that's not necessarily always the case because maybe sometimes the socially optimal tax rate that prices in externalities doesn't lead to smuggling.
Yeah.
I mean, also another tricky thing is like with sugar, these soda taxes or whatever. Like an issue, you end up with a lot of substitution where you end up buying something else that is not good for you with the other money. So or with the money instead of buying something that has soda taxes. So like you drink less soda, but you eat more candy, and I mean that does kind of the same stuff.
So you've got to be thoughtful with what it is you're taxing here, so that you don't just say, create an unintended handout, to the candy people at the expense of the soda people, right?
Yeah.
Okay. All right. Well, that makes sense. So I'm trying to think of if we've got anything else here. And folks, if you've got any other questions, I think we're almost here to our hour. Um, it's such an interesting issue to me because there's just so much to it and it affects so much. And I guess, folks, if you've come up against anything else, maybe just the complexity of the issue seems to be one reason why people don't talk about it so much, even though it's clearly so important. Captain Bagels, I'm not going to ask how can I avoid paying taxes. That's probably not the kind of question we've got here. Okay. Let's see. I guess I think that's about it. Unless anybody has any other questions. Let's see. One question here, as far as one more question from John Smith here. Government debt. And maybe you can speak. This isn't quite just taxes, but I guess maybe... Oh, sorry. Actually, this one is directly related. And Estonian Spy, actually, I'm going to ask this one, too. I'm going to ask this one specifically. Okay. Wealth taxes. That's a good one to end on. How do you feel about wealth taxes? I guess maybe irrespective of... I know some people have argued they're not constitutional. But in terms of if they were implemented, what do you think the effects of those would be?
I think that what you'd see is, I think the trouble there is more about liquidity necessarily than investment. Because the trouble is that when people talk about like the net worth of Jeff Bezos or any other rich person, is that the money is not sitting around in cash in some bin somewhere. Like the money is locked up in factories and distribution centers and all of these other things, and it's going to be hard to like administrate that. And you don't want to have a situation where people have to shut down, like sell off warehouses or whatever, and do all of these things to have the liquidity to pay a wealth tax bill. Another trouble, I mean, this is sort of similar with the gross receipts, where what you have is there's sort of if you have a like extremely low rate number that is going to raise a ton of revenue, there's something weird going on economically. It's like very much too good to be true to say like from an economic perspective that like we can just tax this thing 1 cent, 2 cents, and suddenly we'll have this giant amount of money. It's like you're doing something weird. The issue there is like if you look at the sort of normal marginal returns to like savings, let's say you're earning 3% on some bonds that you own, and 2% wealth tax. So like the value of the stuff that you have, if it's growing by 3%, and you're paying a 2% tax on the stock of the stuff, you're effectively paying a just under like a 66% tax on the income you're getting. So like if you own something that goes from $100 to $102 or $100 to $103, and you're paying 2% tax of 103, you are paying 2.06 of the $3 that you earn, if that makes sense. So in that example, a wealth tax of 2% would be the same thing as a income tax of 66%, or something like that. I think that's sort of the tricky thing with wealth taxes. I think that's tends to be like my impression of them from Europe is not so much that they're like the worst thing for growth per se, although a lot of the wealth taxes in Europe were also a lot lower than 2%. My sense was more that they were just sort of a big administrative hassle that like didn't do much in terms of revenue generation. Like it seems kind of a mess. If you want to raise taxes on high income people, I think you would. You'd get rid of the payroll tax cap, or you'd go after itemized deductions, or there are some corporate provisions that it would make sense to go after. Like I think those things are a much better place to start, especially working within existing administrative structures that we already know kind of work. Speaking of administrative structures, doing better funding the IRS.
It does seem like the IRS is not given the resources it needs to tax a massively wealthy country of 330 million people.
Yeah, I think that that is one disagreement I have with like libertarians or conservatives that like, no, I'd actually rather have the IRS work okay.
Yeah.
Then you could cut other taxes
Mm-hmm.
if we knew how to collect the ones we have.
Yeah.
Um,
Yeah, I mean, it
uh,
makes sense. If you're going to have the law, you know, and
yeah.
I guess you might decide to enforce it or not to enforce it, but to enforce it only, to give you a budget so that you really aren't making that choice. You're just stuck doing, grasping for straws. That doesn't seem right. Okay. And I follow up on that one, and then one last question.
Sounds good.
So the follow up is, I know you said there's a liquidity problem, and certainly that makes sense with something like, say, I guess if you're taxing somebody's mansion, right? I mean, and then presumably you are stuck with either, I guess, ponying up the cash or selling it to generate the cash. But what about, I mean, folks like Jeff Bezos, a huge amount of their wealth is locked up in stocks, which are, maybe not as liquid as cash, but which can be turned into cash relatively quickly. I mean, would it be such a problem to levy wealth taxes on some of these billionaire types?
And I think that the mansion example is actually kind of interesting because the mansion example is one area where I'd be kind of fine with that.
Huh.
Because the mansion is consumption.
Mm-hmm.
And the stocks, indirectly are ownership of things, of Amazon's business. If you tax the mansion more, maybe he sells it, he moves to another house.
Yeah.
But like that doesn't have a huge impact on employment per se or productivity. But like if he has to sell off Amazon, he maybe ends up having to reduce the activities that Amazon does. And those things are more broadly useful societally, I think. Yeah. That having more, I mean, this is sort of going back to like, I'd rather have people raise high personal income tax rates versus going after corporate stuff.
Yeah,
generally.
That makes sense.
If you can tax there's some idea I've recommended people looking into, which is like the progressive consumption tax idea pushed by Ben Cardin of Maryland. He's a good Democrat guy from Maryland, and he has this idea for it's basically a VAT, I think, but there are some I want to say is it cash transfer or rebates or something to rate the regressivity. But basically the idea is ideally you'd coming up with ways to tax rich people's consumption is like the idealized form of progressive taxation, but you don't want to go after investment.
Yeah.
And designing that, I mean, is tricky. Like that's the thing with the estate tax. Theoretically, like from a moral justice perspective, I think the estate tax is like eminently very reasonable. Yeah. It's like you worked for your stuff, but like your goddamn worthless kids.
But I mean, but how can you say that? Like your kids may be worthless, but it was your last wish as the person who worked for the stuff to give it to your worthless kids, right?
Right. I mean that is my problem with it in practice. Is that like one of the reasons? I mean, this is a joke my brother, who's actually a stand-up comic, likes to say, is that in America, the dream is that you come to America to build a life for a better life for your children. Yeah. But if you're those children, you're kind of a dick. Like, shout out to my brother Toby Muresianu. Anyways,
I actually have seen him on Twitter before, and I thought, are those two related? But okay, cool, good to know.
Brothers, yep.
Right on.
But basically, I mean, that's the thing, is that one of the reasons people, invest to try to accrue wealth through work or investment is to pass on something to their children. And evidence seemed to show that the estate tax does do a lot to disincentivize that, and we don't want to disincentivize people investing or working and stuff. And so I think there are some ways, like I've heard that doing like an inheritance tax, which is different from what an estate tax, because the estate tax is like on the estate itself, whether I think the inheritance tax is like treating an inheritance that you receive as like income, kind of.
Oh, I see.
Something like that.
That's I can see how that would still be different than taxing the whole thing, which you might not just put to somebody's inheritance, but which you might, use in other ways, and maybe start a foundation or something. I don't know.
Actually, on the foundation thing, I mean, I think that was something I want to say Niskanen Center had an interesting paper about that, where like that's part of the reason why you have. I mean, they made like a very weird argument against the estate tax, where it was like, if you have an estate tax, then like people will take their money and they will put it into like conservative foundations, like don't like progressive politics.
There you go. Okay.
Because then it wouldn't be taxed because it's in a foundation.
Okay.
It was a very interesting, like weird. It's like I'm not sure how much of the consequence of the estate tax is people putting money into the I don't know.
That's a trip. Like, I like the argument, even though you're right. It's fun to imagine that.
Effect is.
You know how many people are saying, well, you know what? Because these Democrats, these liberals gave me this tax on estates, I am leaving all my money to the Heritage Foundation or whatever.
Yeah. I don't know. It was an unorthodox take that I had to respect.
Well, let me ask you the last question of the night then. Let's see, on Tuesday we spoke with Brian Kaplan, and he told us that, kind of in passing, that the U.S. tax code is actually, in the final analysis, pretty progressive. And the real issue, if you take issue with the U.S. tax system, is really on the spending side, how we spend. For example, we spend a lot more on the military than a lot of our peer countries would, and less on, say, health, for healthcare for all and so on. But the tax system itself is relatively progressive, maybe even more progressive than in some of these peer countries in Europe. Do you think that's a fair statement?
I think so. I mean, what is defined economically as like progressive is kind of difficult to parse. I can't remember what the example is, but like if you had a tax system that like had its rate of 0, everybody, except for Jeff Bezos, and he paid a tax of like 10%, like the way that would show up as a distribution would be like, this is the most progressive tax system we've seen. I think that's how some measures of progressivity work. Now that's an extreme example, but like I can understand why. I think it does make sense, but it's also important to remember that taxes do not occur in a vacuum. Taxes are part of what we do to fund government, that and borrowing money, and like what you do with that spending is also quite relevant. So if you have a flatter tax system, but you have a more progressive spending distribution, it's a similar effect. Like, so I mean, I think the American tax code is progressive. It is more than proportional. It's not. I know Sayez and Zuckman have their thing about how it's not, because they count private health insurance premiums as taxes, which is weird.
Yeah.
But so it is like more than proportional. Like, poor people pay a lower percentage of their income in taxes on average than rich people do. So it is progressive. But I guess looking at it in isolation is an undercooked analysis, I guess.
Okay. Well, hey, on that note, I like that. Good note to end on, because that's something that I hadn't thought about until he made that point, and so I was curious about your take on it. Well, we bounced all around all kinds of tax issues tonight. Alex, I really appreciate your time. It was great talking with you. I appreciate your patience explaining some of this to me, and I don't know. I hope you had a good time chatting with us tonight.
Absolutely did. I hope everyone else enjoyed it. I shout out to anybody who's still watching.
Oh, no, actually, we have more people than we did when we started, so that's a success. Wow. I'd say. Yeah, I know. So thank you so much for that. I hope we can have you on again sometime when we, maybe, we have another round of tax cuts, or maybe Joe Biden's proposal to raise taxes on certain people. Whatever the future may hold, it'd be great to talk with you about it. So.
I'd love to be back. This was great.
Well, thank you so much. I hope you have a good night. Thanks, Alex.
Thank you. You too.
Take care.
Bye.